My friends, the market likes to pretend it understands the future, yet it refuses to look at the forces shaping it. It studies charts, debates interest rates, and trades digital contracts as though they represent something real. But the real world isn't formed inside trading rooms. It's formed inside mines, factories, laboratories, and production lines. Their mathematics makes decisions that investors cannot escape. Industrial demand isn't slowing. Mining output isn't expanding. And the physical supply chain doesn't care what the screen price says. We are watching a material that has become essential, scarce, and mathematically irreplaceable. The world thinks silver is a commodity. The numbers say it is becoming a necessity. Mathematics doesn't predict maybe. It predicts certainty. It doesn't care about sentiment, headlines, market opinions, or fear. Numbers do not bend to narratives. They force truth. And today, the truth is unfolding inside a market that most people treat as an emotional gamble. They look at silver as though it were a coin, a commodity, a relic of history, but mathematics sees something very different. It sees a finite supply colliding with infinite demand. That collision is not a possibility. It is not an assumption. It is a mechanical outcome, a certainty. Consider the world we're building. We imagine a future of clean energy, autonomous cars, accelerated computing, and artificial intelligence. Every one of those visions requires electricity, circuitry, and ultra-conductive materials. They require something better than copper, faster than gold, more efficient than anything we've used before. And there is only one metal that satisfies all those technical demands simultaneously. Not because someone said so in an article, but because physical properties make it unavoidable. Silver isn't optional in this new world. It's foundational. Now, bring in the numbers. Annual industrial demand has surpassed mining production, not theoretically, not. Eventually, it happened already. The data is public, but ignored because markets don't look where math looks. They look where money is easiest. That's why they almost always respond after the fact, trying to interpret what mathematics had already proven long before the event occurred. Mining companies are digging deeper for lower-grade ore. Energy costs to extract it rise, labor shortages grow, environmental rules tighten, and yet consumption accelerates. Solar technology alone consumes more silver every year than the mining industry can comfortably replace. Add electric vehicles, connectivity, server infrastructure, and AI hardware, and you get a pattern in which usage compounds. These industries don't slow down, they scale exponentially. That's the critical word, is exponential. When demand compounds and supply contracts, you don't get balance, you get a tipping point. Most investors think in straight lines, up, down, sideways. They ask whether the price might move 3% higher, 5% lower, or 20% next year. Mathematics doesn't think in lines, it thinks in curves, acceleration, and breaking points. When the curve of demand rises sharply, while the curve of supply declines, the only variable left is price. Price doesn't gradually adjust. It jumps. It gaps. It redefines itself. That is where silver stands today. Not in a place of speculation, but in a corner created by arithmetic. You can temporarily manipulate paper contracts, futures trading, or investor psychology, but you cannot print physical material. You cannot trade what no longer exists. At some point, buyers will require delivery. When they do, the illusion of abundance evaporates, and the market must reprick the metal according to physical scarcity, not opinion. People confuse uncertainty in time with uncertainty in outcome. The timing of the market shock is unknown, yes, but the direction is certain. That is what mathematics tells us. The price shock will come because the inputs make it unavoidable. And when the world is forced to confront the shortage, the price will not respond politely. It will respond violently. This is not prediction based on wishful thinking, historical nostalgia, or conspiracy. It is based on quantifiable constraints. A market built on real physical limits cannot behave like a market of digital currency or printed debt. You can expand money. You cannot expand metal beyond what geology and energy costs allow. And you certainly cannot do it fast enough to satisfy industries on a global scale that are consuming it at exponential speed. Markets like to pretend they are driven by logic, but they are driven by delayed recognition of mathematical truth. They wait until truth is undeniable. Then they panic trying to adjust to it. When that moment arrives for silver, the price will not rise simply because people want it to. It will rise because the world needs it, and there is not enough available. Need is not emotional. need is absolute. And when absolute need meets absolute limitation, price becomes a mathematical verdict. That is why mathematics doesn't predict. Maybe it predicts certainty, and certainty has already chosen silver. The market just hasn't realized it yet. Industrial demand is skyrocketing not because people are suddenly fascinated with silver, but because the world has quietly built its future on a resource it barely understands. The demand is no longer controlled by investors, traders, or analysts. It is controlled by engineering requirements, physical laws, and technologies that cannot operate without this material. When a resource becomes indispensable to the infrastructure of modern civilization, market opinions are no longer relevant. The engineers took control of this story, and the mathematicians confirmed where it ends. The transition toward electrification is not a trend. It is an irreversible trajectory. Solar energy doesn't grow linearly. It compounds. Each year, more countries commit to renewable mandates. Every panel installed feeds into a larger grid. Every grid expansion requires more panels. And each of those panels contains silver in a quantity that is technologically necessary. You cannot replace it without sacrificing efficiency. And efficiency is the entire purpose of solar technology. Silver isn't filling space. It's performing a function that physics requires. It acts as the world's most efficient electrical conductor at scale, and every improvement in solar energy increases the amount demanded per unit of power. So the better the technology becomes, the more silver it consumes. Electric vehicles are another layer of mathematical pressure. A gasoline engine needed metal for mechanical components. An electric vehicle needs conductivity, circuitry, and uninterrupted power transfer. It is essentially a network of high-efficiency pathways, and each one functions better with silver. As adoption accelerates, so does consumption. The demand doesn't just grow with each car. It multiplies across manufacturing ecosystems, supply lines, and charging infrastructure. Charging stations are themselves dependent on conductive materials. Multiply that across continents and the numbers stop behaving like a commodity market and begin behaving like an inevitability. Then there is computing, the hidden giant. Modern data infrastructure is expanding faster than energy infrastructure. Artificial intelligence consumes computing power at a rate no previous technology demanded. Data centers must expand, upgrade, and cycle hardware constantly to stay competitive. And the chips at the core of this transformation cannot maximize speed without highly conductive materials. There is a threshold where speed, heat dissipation, and reliability converge, and silver crosses it before any alternative. That threshold does not care about market prices. Engineering requirements don't ask whether silver is too expensive. They require whatever material performs best. Most people evaluate demand through growth forecasts. That is a mistake. Industrial demand isn't growing. It is stacking. Each technology layer does not replace a previous one. It adds another burden on supply. Solar doesn't reduce EV demand. AI doesn't reduce solar demand. Data infrastructure doesn't replace vehicle electrification. Everything grows together, and every growth sector consumes silver. The market is behaving as though this demand is speculative and temporary, as if the world might abandon solar panels, electric vehicles, or computing advances. That is not how technology evolves. Once adopted, it becomes mandatory. Nations won't dismantle renewable grids. Companies won't shut down data centers. The automotive industry won't revert to combustion engines after billions in electrification investment. Once infrastructure commits, silver becomes a locked requirement, not a choice. That lock is the real driver of demand. It is not that silver is popular. It is that civilization has integrated it structurally. What makes this situation mathematically compelling is that demand does not need to grow exponentially for a crisis to occur. It only needs to stay where it is. The current level of industrial consumption is already exceeding mining production. Even if growth stopped today, if technology froze in place, the supply would still fall short. But technology is not freezing. It is accelerating. That acceleration compounds demand in a way that physical extraction cannot match. This divergence is where markets fail to understand scale. Investors look for sentiment, cycle, speculation. Industry looks for solutions. And industries do not slow because prices rise. They simply pay whatever price the physics of innovation requires. If the world needs conductivity, precision, speed, and energy transfer, It pays for the material that performs best. So industrial demand is not just increasing. It is enforcing a price transformation. It is creating a world where scarcity is guaranteed, not by market psychology, but by the momentum of innovation itself. When supply cannot grow and demand refuses to slow, price becomes the mechanism that forces equilibrium. That is why this demand matter does not ask permission. It does not wait. It consumes. And in that consumption lies the inevitability of what happens next. Mining output is declining, and it's not because companies suddenly became inefficient or miners forgot how to dig. It's declining because the ground no longer gives up silver as easily as it once did. The easy deposits were extracted decades ago, leaving behind ore that requires more energy, more money, and more time to obtain. This decline is not a temporary inconvenience. It's a structural limitation. People mistake price cycles for geological constraints. But prices can move arbitrarily. Geology does not. Silver doesn't exist in neat, concentrated masses waiting to be collected. It exists mostly as a byproduct of mining other metals: copper, lead, zinc, even gold. That means silver supply isn't determined by silver demand. It's determined by the economics of mining other materials. If copper demand weakens, copper mines reduce output. When that happens, silver production falls. Even if the world desperately needs more, you cannot mine more silver simply because the price rises. The material is not found independently in enough volume to justify standalone mining. In most regions, the industry is trapped between need and limitation. This dynamic becomes even more mathematically restrictive when you add declining ore grades. An ounce of silver used to come out of rock with higher purity. Today, the same amount requires moving more earth, consuming more diesel, using more chemicals, and processing more waste. The energy cost becomes a larger percentage of the extraction cost every year. At some point, the expense surpasses the economic incentive, especially when mines are already battling labor shortages, environmental regulations, and political instability in mining regions. Many people mistakenly believe that higher prices will magically increase production. Prices can stimulate exploration, but exploration is a gamble, not a guarantee. It involves drilling geological surveys, waiting for approval, building infrastructure, and hoping the deposit is worthwhile. And even when a significant deposit is discovered, it can take 10 to 15 years to become an operating mine. The world can increase industrial silver consumption in a year. It cannot increase mining output at the same speed. That mismatch alone is a mathematical crisis. Mining is not scalable like software, finance, or manufacturing. It's bound by physical effort. You can't code new silver into existence. You can't print it. You can't accelerate centuries of geological formation by investing capital. You can only extract what nature placed. And nature does not negotiate with market demand. So when mining output falls, that decline persists even if prices surge, because the bottleneck isn't motivation. It's availability. Recycling is often presented as a solution, but it's not one. Silver used in technology is dispersed in microscopic traces inside circuits, batteries, solar cells, and industrial catalysts. Recovering it is complex, expensive, and frequently not economically viable at current technological standards. Unlike gold, which is hoarded and easily recovered from jewelry or vault, silver is consumed and buried inside devices that are not designed for retrieval. Recycling cannot catch up with rising demand when the material disappears into the infrastructure of modern civilization. Look at the trajectory. Mining is stagnating or quality is declining. Exploration cannot scale fast enough, and recycling is insufficient. Future supply is not a function of human effort. It is a function of geological and industrial constraints that creates a mathematical imbalance. When supply cannot expand to meet rising consumption, the market doesn't resolve this imbalance gradually. It resolves it suddenly through pricing shock. Price becomes the only mechanism available to ration what cannot be produced in greater quantity. Governments and corporations assume that supply will somehow appear because industry needs it. They operate under economic optimism, not geological realism. They act as though every necessity finds a market solution, but nature does not produce on demand. There is no negotiation with our bodies. There is no contract miners can sign with the earth to increase output. The world expects to electrify cars, transition to clean energy, expand data infrastructure, and digitize every industry. Each of those goals has been priced in financially, but not physically. Budgets are prepared, factories are planned, grids are being redesigned. Yet no one has solved the question of where the required materials will come from. Silver is being committed without being sourced. Those commitments are locked in. They will not reverse. So mining output doesn't just limit supply, it reveals the flaw in global planning. The future is being built without enough resources to power it. And once the market realizes that deficiency price will not rise because investors want profit, it will rise because civilization does not have another choice. Financial markets are ignoring physical shortages not because they don't exist, but because markets rarely look at what cannot be seen on a trading screen. They react to sentiment, liquidity, leverage, arbitrage opportunities. They follow the movements of contracts and derivatives, not barrels, tons, or ounces of tangible supply. The people trading silver today are not taking delivery of metal. They are trading the idea of silver, the symbol of it, the statistic of it. In that abstract world of paper and speculation, shortages appear irrelevant. A button can sell 1,000 tons with no warehouse, no inspection, no confirmation that the metal exists. This detachment allows markets to pretend scarcity isn't real. The system creates a strange illusion. When more contracts appear, it feels like more supply has been created. In reality, nothing has been produced. Only promises have multiplied. These contracts operate like empty containers filled with value only if someone demands delivery. As long as no one asks for physical metal, the game continues and paper can represent abundance. The shortage remains invisible until a buyer insists on reality. Markets are comfortable as long as no one wants the truth. But truth eventually becomes unavoidable. Financial traders rely on models that treat commodities as cyclical, assuming supply will expand when price increases. They believe high prices discourage demand and low prices discourage supply. But physical commodities do not respond to financial theory when the constraint comes from physical scarcity. If mining cannot increase production because our quality is declining and geology is uncooperative, price cannot solve the problem. If industrial demand is inflexible because technology depends on silver, price cannot reduce consumption. This breaks the traditional cycle model. But financial markets still praise silver as if cycles were guaranteed. The paper market amplifies the illusion through leverage. A single ounce of silver may have dozens of claims against it. The futures market trades silver dozens of times over before any delivery occurs. The system assumes that not all holders will request metal. This assumption works until someone challenges it. The fragility lies in concentration. A small percentage of contracts demanding physical delivery can drain available supplies. Once that happens, the price is no longer determined by traders. It is determined by scarcity. Markets ignore shortages because they believe shortages are impossible. The logic is circular. Or if shortages were real, the price would be higher. Since the price isn't higher, shortages must not be real. This is how financial reasoning replaces physical reality. It is an era fueled by liquidity, not evidence. As long as traders can exit positions quickly, they believe they understand the market. But real shortages do not unfold on trading screens. They unfold in factories, smelters, solar manufacturers, and automotive supply chains. Industrial users do not trade silver contracts for profit. They acquire metal because their survival depends on it. They cannot hedge against scarcity with financial instruments. They need to take delivery. They require inventory, not paper. When their needs exceed what the market can supply physically, they will pay whatever price is necessary. Financial speculation becomes irrelevant at that moment. The market resets according to industrial necessity, not trader psychology. This reset will not be gradual. Markets do not adjust smoothly when illusions fail. They break. Confidence disappears instantly when a commodity required for global infrastructure becomes unavailable. Traders who never plan to take delivery discover that they hold claims on metal that cannot be delivered. Prices do not rise because someone predicts they should. They rise because shortages eliminate the option not to pay. The irony is that the financial world treats silver as though its scarcity is exaggerated, while industries treat silver as though its availability is assumed. Both sides operate without acknowledging the finite nature of supply. They behave as if production equals need, yet geological limits do not respond to investor optimism or industrial planning. Markets ignore physical shortages for the same reason they always do. They wait for a crisis to price reality. The longer they ignore it, the more violent the reckoning becomes, because when truth finally enters a market built on paper, it doesn't argue with sentiment, it destroys it. And once the physical world demands more silver than paper markets can. Pretend exists, price will cease to be a number negotiated on screens. It will become a consequence of scarcity, decisive, unforgiving, and absolute. The future won't be dictated by market opinion. It will be dictated by shortages. Prices will not rise because people speculate, but because industries panic. Silver will not be valued for what it once was, but for what civilization cannot function without. When reality collides with paper markets, sentiment will evaporate. Only those holding something tangible will benefit. The world isn't asking whether it needs silver. It is building a future that requires it. And mathematics has already decided where that leads. The market will discover it later. But by then, the price will no longer be a negotiation. It will be a